Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of what companies are trying to hide in plain sight. Today we are diving into a very interesting filing from Rigel Resource Acquisition Corp that basically announces the end of an era for them. So it looks like Rigel Resource Acquisition Corp, which is a company that was set up to acquire another company, has decided that their time is pretty much up. They were supposed to do a big deal, a business combination, but that is not happening anymore. Honestly, this is a pretty common outcome for these types of companies, often called SPACs or Special Purpose Acquisition Companies. They are essentially blank check companies that go public to raise money and then have a deadline to find a company to merge with. If they don't find a deal, they usually have to pack it up and go home. And that is exactly what is happening here. Rigel had a big agreement, a business combination agreement, or BCA, with a company called Blivor Gold Resources Proprietary Limited. This was supposed to be their big merger, but on the 7th of November 2025, both sides agreed to just call it off. The good news for Rigel is that it doesn't seem like they have to pay any big fees or penalties for walking away. This means they can probably return the money they raised to their investors without too much of a hit. And that brings us to the main event, which is that Rigel has officially determined they will not be able to complete their business combination before their deadline. That deadline is the 9th of November 2025. Because they missed this deadline, Rigel says they are going to dissolve and start to wind down. This means they will be giving back the money they raised to the people who invested in them initially. So what does this actually mean for the investors? Well, Rigel is going to redeem, which is basically a fancy word for buying back all of the Class A ordinary shares that were part of their initial public offering. They are going to take the money that is sitting in their trust account, which is the money they raised from investors, and return it to these shareholders on a pro rata basis. That means everyone gets back the portion of money they put in, minus a small amount up to $100,000, that will be used to pay for the costs of winding down the company. Now, if you were a holder of the company's warrants, which are like options to buy shares, tough luck. Those warrants are going to expire worthless. Essentially, if you held these warrants, you are going to lose whatever you invested in them. It is a common but harsh reality for warrant holders when these SPAC deals fall apart. To wrap things up completely, Rigel also plans to file with the Securities and Exchange Commission, often called the SECT, to stop its securities from being registered. This is basically the final step in shutting down the company's public trading life. This whole situation highlights the high-risk, high-reward nature of these special purpose acquisition companies. They can be a faster way for companies to go public. But as we see here with Rigel, if a deal doesn't materialize within the set time frame, the investors often get their money back, but the company itself ceases to exist. Led by Jonathan Lamb as Chief Executive Officer, has followed the rules and is now orchestrating a graceful exit for the company and its shareholders. Now, looking at this filing more broadly, it's not about financial performance because the company didn't really have any operational business. It was all about the deal. The closest thing we have to financial numbers here are the facts that they are going to return capital to shareholders. Essentially, they raised a certain amount of money and they are going to give it back. Minus expenses, it signifies a failure to execute a business strategy, which is a significant weakness. The market for SPACs has also become a lot more challenging, making it harder for these companies to find suitable merger targets. The notable risk here is the inherent risk of the SPAC model itself. If a deal isn't found, the company liquidates. For investors, the opportunity was to participate in a potentially successful merger, but the risk was always a total loss of investment in the warrants, and the time value of money lost on shares if no deal was done. In conclusion, Rigel Resource Acquisition Corp is effectively closing up shop because it couldn't find a business to acquire within its allowed time. For shareholders who bought the public shares, they should expect to get their initial investment back, minus a small fee. For warrant holders, it is a complete loss. This filing is a clear signal of the SPAC's endgame. Alright, that is our breakdown of Rigel Resource Acquisition. Corp's filing, what is your take on these SPAC endings and what they signal for the market? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.